Hi, and welcome to the first part of Orange Mortgage and Finance Broker's First Home Buyer Explainer video series. Usually, the first question first home buyers ask is, how much can I borrow? There are two parts to this answer. What is the maximum loan amount? And what is the maximum loan to value, also known as the LVR, the bank is willing to lend to? The maximum loan amount is calculated as a combination of your income, your living expenses, and if you have any other liabilities like credit cards, a personal loan, or car loans. The amount you can borrow is calculated from your income minus expenses minus liabilities minus the new loan repayments. Even though interest rates are around 6%, the banks will stress their calculation assuming interest rates are at least 9%. Banks need to make sure you can afford it if interest rates go higher than where we currently are. Now, the second part of the question is, what is the maximum LVR you can go to? Most banks for first home buyers will set the maximum LVR at 95%. Including lender's mortgage insurance or LMI. This means you are borrowing 95% of the purchase price of the home. LMI is insurance the bank makes you pay to protect them. This means when the bank says you need 5% savings, you actually need 5% plus whatever the LMI costs is. Remember, you will also have settlement agent fees and other costs you need to cover. When you add this all up, you need to have about an 8% deposit for most lenders. There are a few lenders who will go to 97 or 98% LVR, so you might need something closer to a 6 or 7% deposit. These lenders typically charge 1 to 2% more interest rate at these high LVRs, so usually they aren't a great idea. Currently, the better idea for some clients is the Home Buyer Guarantee LMI waiver scheme. Currently, there is a government LMI waiver scheme, which means the deposit required is reduced by the LMI amount. This means if you have your 5% plus settlement costs, you can get into your own home sooner. Most lenders under the scheme give you the same interest rate as if you had a 20% deposit. So this is a great option if you meet the requirements. There are three classes of the scheme. These are the first home buyers, regional first home buyers, and the family home guarantee for single parents. The key requirements of the first home buyer scheme and the regional first home buyer scheme are: you are an Australian citizen or permanent resident over 18 years of age, or a New Zealand citizen holding a special category visa subclass 444. Friends and family now purchase as part of a couple, still a maximum of 2 applicants. Singles with taxable income of up to $125,000, or couples with taxable income up to $200,000. You must have between 5% and 20% of the value of the property saved as a deposit. You must live in the property. The scheme is now open to anyone who has not owned a property in the last 10 years. Remember, the family home guarantee has the same requirements, but you must be a single natural or adoptive parents or single legal guardians of at least one dependent. Here are the price caps for the scheme. Okay, click the next video which explains the first home owner's grant and stamp duty concession. See you in the next video.